Hey everybody, welcome back to the channel. My name's Phil and this is Grow Your Dough. Grow Your Dough is an educational channel where we try to encourage everyday people from all walks of life to consider investing in the stock market. Remember, I'm not a financial analyst, I'm not an accountant, I can't dissect a balance sheet, but I found ways to invest in the stock market, and what I'm trying to do with this channel is show you the way forward and how you too can invest in the stock market. So today's just a short video just to explore the idea of dividends and what they are. So let's crack on with it. Okay, so today's topic is dividends. When a company makes a profit, they've got a couple of options as to what they can do with the money that's left over. They could plough it back into the business to help develop new product lines, employ new people, open up new offices, do some company research, buy other companies. But one of the other options they have available to them is to give a reward to all of the people who've invested in the company so far. And that reward is called a dividend. The managers of the company decide how much money they have available to distribute to shareholders, and then that is paid out to all of the shareholders who currently have a share in the company. Dividends can typically be paid annually, half-yearly, sometimes quarterly, and there can be special dividends when things have gone particularly well and the management team wish to reward the shareholders. Dividends tend to be paid by companies that are mature and established, whereas smaller companies that are looking to grow and expand and develop their product range or increase their footprint, reinvest their funds back into the business in order to grow it. The payment rate, or the dividend per share, sometimes called DPS, is the amount of money you receive per share. There are different types of investors investing in the stock market. Some people want the money they invest to grow and grow and grow so that when they come to sell the shares, the value of the money they originally invested is multiplied. They're after capital appreciation. But it could be that you're a capital investor and that by chance with the companies that you buy, you just happen to get a dividend. And that's an added bonus. It might be something that you're not necessarily looking for, but if you receive it, then that's great and it can be really, really helpful. However, there's another group of investors called income investors. They're not so interested in capital growth. What they want is a regular income stream from their investments. So for example, maybe they're retired and they want to know that if they put some money to work, that they can guarantee that they'll get a regular income stream that will help them in their retirement. So shares that pay a handsome dividend are really attractive to income investors. But how can you compare the dividend payouts from one company compared to the other? If one company is paying a dividend of 5p per share and the share costs £1 to buy, is that a better deal than a share that is paying 10 pence per share yet costs £5 to buy? To work that out, you use a term called dividend yield. Dividend yield is a ratio between how much the dividend is paid out and how much it costs to buy their share. So in the example of a dividend being 5 pence and the share costing £1, the dividend yield is 5%. In the case where the dividend is 10 pence per share, but it costs £5 per share, the dividend yield is just 2%. So the first option represents a better investment for the income investor. Some companies that pay a dividend strive really hard to make sure that they are paying an increasing dividend each year to reward the shareholders and to keep them invested within their company. And when a company cuts its dividend due to financial difficulties, sometimes that can send shockwaves through to the share price as income investors switch horses and move to another company that's paying a more attractive dividend. How can you tell how secure a dividend is for a particular company? There's another ratio called dividend cover. Dividend cover compares the amount of profits generated by a company compared to the anticipated dividend payout. For example, if I generated profits of £2 million in my company and planned to pay out £2 million in dividends, I'd have a dividend cover of 1. 2 million divided by 2 million. However, if I generated profits of 4 million and paid out 2 million in dividends, I'd have a dividend cover of 2. So the dividend cover ratio is there to give us a quick guide as to how safe the dividend payout is going forward. If a company has a dividend cover of less than 1.5, it might be that the dividend is at risk of being cut by the management team. Whereas if the dividend cover is greater than 2, that's generally considered as healthy and safe. To qualify for a dividend, you must be holding the share when the dividend date occurs. And if you hold the share on that date, then you will receive the dividend payment. The day after that date is called the ex-dividend date. And so when the stock goes ex-dividend, if you buy on that day, you're not entitled to the dividend payment. Typically on the day the stock goes ex-dividend, you'll see a corresponding drop in the share price. So if the dividend yield is 4%, then on the day that the stock goes ex-dividend, the share price will drop by 4%, representing the fact that if you buy the share now, you're not entitled to the 4% dividend. So there's some gotchas with dividends. Dividends will count as income, and if you receive income, then there's a potential to be taxed on it. So once again, I can't stress enough, it's really important to get your investments inside a tax-free wrapper like an ISA in the UK, or a SIP, which is a self-invested personal pension plan, or there'll be other tax-efficient wrappers, no doubt, in other countries. In the UK, if you have your investments inside an ISA, then any income you receive goes straight into the ISA and is not subject to tax. So that's really important. Another gotcha as well is if you're buying international stocks, sometimes the foreign government will apply taxes to your dividends at source. And it can be a bit of a faff. It's called withholding tax. And it can be a bit of a faff to try and recover tax from a foreign government or to get the right level of tax rate set. Sometimes it might just be easier just to not go through the hassle of trying to recover the extra tax and the time it takes to do that. But it's just something to be aware of when investing in foreign companies that pay a dividend. When you look at a stock report for a particular stock, and here we're looking at the UK retailer Next, the dividend yield is highlighted in the top right hand corner here. So Next has a dividend yield of 2.19%. And you can see how that compares to the rest of the specialty retailers in the UK. It's 6th. And how it compares to the whole market overall in the UK and Ireland. As you scroll down the stock report, you can see there's a whole section here on dividends. And the first row is dividend per share. And you can see just by hovering over it, the value per year. And the two last columns with an E after them, 2021 E and 2022 E, are estimated. The next row down shows the growth in that dividend. Obviously in 2020, lots of companies cut their dividend due to the COVID pandemic, and that's reflected here. But obviously Next are looking to re-establish that dividend going forward in 2021, 2022. There's also the corresponding dividend yield. And here you can see the dividend cover that's available for each of those years too. And if you hover here, you can see the ex-dividend date for this particular share is the 5th of December. So you have to own the share on the 4th of December to receive the payment, and it actually gets paid to you on the 2nd of January. And in fact, we can click this link and you'll see a history of dividends paid out. This company pays dividends twice a year. They pay an interim dividend and a final dividend. And they've also, you can see that they've paid special dividends over the years too, where the performance of the company has been good. So there we are. That's what you need to know about dividends. They're bonus payments to shareholders from the company management team thanking you for investing within the firm. And they're paid out depending on how many shares you own within the company. So I hope today's video has been useful to you. If it has, then please give me a thumbs up or add some comments below if there's anything I haven't covered. If not, I look forward to seeing you in the next video. Take care for now. Bye.